Tuesday, August 13th, 2019, Maneco 64, home of alternative economics and contrarian views. This morning, before I start, I'd like to thank all my viewers, all my subscribers, for their interest in what I have to say, for their feedback, for their interaction during live streams, also in the comment section. This is what builds the community, so to speak, and it helps me also come up with subjects to speak about, your questions, your comments, and of course to all of you as well who have contributed financially through donations, through PayPal, through Patreon, through the Teespring store. I appreciate it very much. Also those who are patient to watch a lot of the adverts, that helps. Thanks again. So this morning, I want to talk about how the central bankers are the ones to blame for the sub-zero interest rates or the negative yields in bonds, which is something that a few years ago would have been people, if you told them that bonds were going to yield negative, that you would pay someone to lend them money, they would have laughed at you. I've spoken about books on my shelf, like the Handbook of Fixed Income Securities by Fabozzi. You go through that book, there's nothing about negative interest rates. It's a completely central banker created scenario. There's no, how can I say, conundrum about it. It's the bond put, so to speak, because the central bankers, the powers that be, the governments, and central bankers and central banks are not independent. They need to keep the system going. They need to keep the debt bubble going, and the governments are the biggest borrowers. All this dispute between Powell and Trump is just for public consumption. Central banks are not independent. And they've created this. They've given, how can I say, speculators and investors, they've told them, don't worry about bonds. We're going to keep pumping that kind of assets. And it started, I would say, with QE after 08, 09, and especially with Mario Draghi in 2012, when actually European peripheral bonds like Italy, Spain, Greece, Ireland, they were collapsing and yields were shooting up. So they, and then he came out and said, I will do anything it takes to save the bond market. And that's why people have, they think the central bankers have their back, and they're, but you never know. That's what I wanted to say, because things could turn very quickly, and the quickly rising prices of these bonds could turn around and crash the system completely, because the other thing, speculators and investors are buying stuff through leverage as well. And you need to remember that these falling yields means rising prices, especially for the longer term securities, because of duration. I spoke yesterday about how the Austrian 100-year bond has gone from 100 cents to the euro to 154 in about 2 years. But that could quickly turn around. There's an article this morning here, SubZero grappling with the topsy-turvy world of negative yields. It says roughly 1/4 now of the global debt market is trading at levels once thought improbable. Bonds worth 15 trillion now, $15 trillion, and it's increasing. Roughly 1/4 of the debt issued by governments and companies around the world are currently trading with negative yields. That means prices are so high that, you see, prices are so high that investors are certain to get back less than they paid via interest and principal if they hold on the bond onto maturity. They are in effect paying someone to look after their money. So would you really want the US government, Uncle Sam, or the UK government, or any government to look after your money. We know what governments do to money. The biggest thing they do to money is to make it worth less. They spend money they don't have. They create inflation. They waste it because it's a monopoly. Give the reasons, the FT. So what is the FT saying here? Why this is happening? So I'll read from the article. It says, if central banks keep cutting rates, as the European Central Bank is expected to do in September, bond yields look likely to follow them lower. The old theory that zero would act as a floor for interest rates has been shattered. However, most analysts feel that there is still some kind of limit, just lower than they thought before. So this is a comment from Adam Posen, a former Bank of England policymaker, they call him. So he says, how low you can set rates depends on at what point you start being counterproductive, said Adam Poser, who is now president of the Peter Institute for International Economics. He goes on to say there are several reasons to think that point might be close, or even that it has arrived already in economies like Switzerland, where rates are currently at minus 0.75%. At some point, savers will prefer to lock banknotes away in the vault rather than submit to punitive negative rates, Mr. Posen urges. Or they'll buy precious metals, right, Mr. Posen? Oh, you don't even know what that is. Anyways, it says that means investors may not be able to ride the wave of negative yields much further, although bond yields have been historically low levels for years. Fund managers have more than made up for the lack of yield with the hefty price gains on their portfolios as bonds rallied. Once the price gains fizzle out, they will be left contemplating an exceptionally bleak bond investing landscape. You see, that's the other point as well. When it starts going down, the yields, and the prices stop going up, I bet you these guys are going to rush to the door, and there's going to be a complete sell-off in the bond market. This is what is the danger. So this is how it ends. It says here, and I'm quoting someone called Mr. Hoffman. It says, I'm worried you become dependent on lower and lower rates, said Mr. Hoffman. It feels like the bond market is suffering from some kind of panic attack. But what happens when rates go up? It's a dangerous game. There you go. No mention of the fact that you have to blame central bankers for this. No mention at all because it's the zero rates that the central bankers set at first and the negative rates that have driven people to buy bonds. The solution to this, which is too late now to do, is to let short-term interest rates or the central bank rates revert back to market rates, which would be a lot higher than 0 or negative or 2% like the Fed. It would be more like 5 or 6%. Historically, that's where interest rates are if you go back 200 years. So now let's have a look at the markets. It's 7:34 a.m. London. Markets are getting very interesting. Stock market had a very rough day yesterday. The Dow dropped almost 400 points. So the technical picture not looking great, as you can see here for the Dow. Looks like a massive top here, as I've been speaking about since the beginning of 2018. And it looks like we're turning back around below that trend line in the Dow. Yesterday, gold and silver had a very good day. They went up in the afternoon. Silver kind of lagged behind, but this morning, silver is leading the way. Right now, spot gold is at $15.24, up another $13, just under 1%. High has been $15.25, and the low has been $15.10. Silver is up 32 cents at $17.38. That's up almost 2%. So that's a good combination there. Silver leading the way. The high's been $17.42 and the low $17.04. What about the stock market? Well, the Dow is down 49. Dow future at 25,852. So down a little more here, 0.2%. S&P is down 6 or 0.2%. NASDAQ 100 future is down 0.25% at 75.42. Fiat currencies, sterling is down 0.2%. It did rally yesterday a little bit, sterling. As I said before, many times things don't go up or down in a straight line. Cable right now, where sterling is at 120.55. The euro is down 0.2 as well, just below 112, 111.94. And dollar is unchanged against the yen, 105.30. Dollar is up slightly against the Chinese yuan at 710.50. Crude oil is down 0.75%. WTI is at 54.48. Brent is at 58.01. And the bond markets had a massive move higher. The prices yesterday. I saw the 10-year yield dropped like 10 basis points in one day, which is massive. So there is panic, as that article in the FT says. A panic basically by the fund managers, by the speculator, not to miss the action in the bond market. So this morning, the 10-year yield is at 163. It's down about 1 basis point. And the 3-month is actually up about 3 basis points this morning. It's at 2.026. So right now we got almost 40 basis points inversion. Yes, I haven't spoken too much about all the headlines, but I think that's all for, how can I say, distractions. Yes, Hong Kong, things are heating up over there. The trade wars, Argentina, Brexit, but keep an eye on the markets, I'd say. Follow the money. So right now, there's a rush to bonds. People consider them safe haven assets because there's trillions and trillions of these securities where they can park their money easily, the fund managers, the speculators. But it's not a game that's going to keep going on forever. It's like a balloon. When you blow it up, at one point it will pop. And when that will pop, it's going to be ugly because, as is being said, we've never seen negative yields. We've never seen this kind of bubble. So I don't know what's going to be on the other side. But one thing I do know is that by holding real things, physical gold and silver, which are monetary assets, you will be protected. If you want to trade them, that's up to you. It's a dangerous game, though. It's more insurance. And also, hold on to tangible goods. I think for real things, because the paper market is becoming totally, detached from reality. And the bond market is the biggest symptom of that. If you enjoyed this video, make sure you hit the like button. Make sure you share it far and wide as well. It helps when people share my videos. I get more viewers, more subscribers, more interest in the subject. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.